Hi folks. Alright, time for another chapter. I really hope that you're up to date with your chapters that you're working through. We're now up to the Perpetual Inventory System chapter. So the reason, there's a reason why I've underlined the Perpetual System there. I'll explain in a moment. But ultimately what this chapter is looking at is how we treat inventory, the buying and selling of inventory within our accounting systems. So to cut a long story short, there's two different styles or types of inventory systems that we have in Australia, and they are the perpetual system and the periodic system. The great thing for us is that we actually only have to study the perpetual system of dealing with inventory within accounting. So within your textbook and other things that you look at on YouTube, etc., they talk about both the periodic and the inventory systems, and they show you how to deal with those. You don't need to know how to deal with the periodic system, but what you do need to know is just a rough overview of what those two systems are and the advantages and disadvantages of both. So I'll go through these really quickly, and then once I've done that, I want you to go to a YouTube link that I'll put up in the description under this little video for you to follow and go there. So the two inventory systems, perpetual and periodic. Periodic is basically the old style of looking after inventory. So it's the old style of doing stock takes. At the start of a period, you go around and you count all your inventory. You take a record of every individual type of inventory, how many you've got. And then during the period, you're buying and selling inventory, and you really have no idea as to how much stock you've got at any point in time. And so quite often with this style, you're running out of particular bits of stock, and you only realise that when a customer comes into the store and says, I want this particular item, you go to get it and there's none there. So there are issues with this old style. And then at the end of the period, we do another stock take, and the purpose of a stock take is to see what we've got, what we're lacking in, and then make orders based on that. So as you can understand, during this period here, there's a lot of information that we're not privy to. We just don't know it, and it's a challenge. With the perpetual system, it's the newer style, and that's probably why we teach it now, because that's what's being used more and more within business. We used to teach this style, now we're teaching this style. And it's basically because of the computerised accounting that's in operation in most businesses these days. It's much easier to keep up-to-date records as to what's going on. So with the perpetual system, it's an ongoing system. If you're looking at a timeline, at any point in time, we can see what stock we've got, and that's because it's computerised. So with every purchase and every sale, the individual pieces of inventory that are purchased or sold are basically being recorded. So on our computer, we can look up stock levels for any item that we've got within our inventory. So it makes things a lot easier and simpler. So for us, within our course, we're going to learn how to deal with the purchasing and selling of inventory and all the other associated transactions that we have to deal with solely for perpetual. You do not need to know how to deal with it with the periodic system. Okay, I want you to pause the video now and go to the link that is within the description underneath this video and have a look at that video. Okay, thank you. Okay, so now we know a little bit about the perpetual system of inventory. Before we get into actually looking at dealing with the perpetual system of inventory, I want to discuss source documents, because it's important that you understand what source documents are, and you're going to be coming across those within questions anyway, so you really need to have an understanding. So pretty much a source document is just the evidence of the transaction. It's what you get if you go to the shop, you buy something with either cash or on credit, you get a source document, the proof. And so when we are given a source document, that's what we use to be able to write out what our transactions are. So that's where the information that is written in your questions come from. They come from all of our source documents. So the example that I've got here is if you go down to Coles, you buy some food, you pay for it with cash, and what you walk out of the store with, apart from your food, is your source document, which is a receipt. So a receipt is a source document when dealing with cash. And basically, from whoever actually is receiving the receipt, they're the customer. So if I walk into Coles and buy something, I'm getting the receipt. So I'm receiving the receipt So that's the source document for a cash purchase. If we are the person that's doing the sale, then the customer will get the receipt, so we give the receipt to the customer, but we keep a copy. So for cash transactions, our source document is a receipt. It's whether or not we've given it out or we've received it as to whether or not we're the customer. For a credit purchase, we receive an invoice. So it's a statement saying basically that we owe money. And for a credit sale, we're the ones that write out the invoice and give that to the customer, and we keep a copy of that. So invoices, whenever you see those, you know it's a credit transaction. And for receipts, whenever you see those, that's a cash transaction. So here we've got an example. So straight away, as soon as I see tax invoice, I know that it's a credit transaction. We've either sold or purchased something. So in this case, we are Bayless Electronics. We've purchased from Simon Fryers, and we're purchasing inventory. So we're planning on selling this for a profit. So we've got a tax invoice, we're the customer, and so therefore it's a credit purchase. So now that we know that, we can look at the information. $600 worth of inventory has been purchased. We've spent or been charged an additional $60 GST. So the total that we owe is $660 to the creditor. Please take note that within this information here, you quite often have additional info that you're going to have to apply in later questions or within the question that you're dealing with. So this one, 10% discount given if paid within 7 days. So when you're working through your transactions, if we actually pay this off within the 7 days, we need to make sure that we apply that 10% discount, because not always will we be told that we need to do that. Okay, so now we need to basically look at the first type of transaction within the textbook that we have to deal with. It's the simplest one. They get a little bit more challenging, a little bit more tricky to understand as we move through. So we'll do the easy one and then go from there. So we've got our source document that we've already looked at. We've purchased $600 worth of inventory, $60 GST, so the total being owed to our creditor is $660. So to place it into the ledgers, very simple. As you already understand and know, we debit both the asset accounts for the 600 plus the 60, and then we credit the liability account of 660, showing the total that we owe. And then to place it into the general journal, exactly the same information, just in the general journal format, so simple again. Okay, so now basically you are ready to do some additional reading from your textbook to make sure that you understand what we've covered so far. Please take notes, please create study notes. You need to know this stuff, and then we're going to practice some questions as well. Okay, good luck.